why a Chinese billionaire just wagered $300 million against silver, and why Trump is resisting back. A Chinese billionaire just placed a $300 million bet against silver, the largest short position in Shanghai Futures Exchange history, 450 tons, 30,000 contracts, all betting that silver will collapse. But here's what doesn't make sense. This is the same man who made $3 billion betting on precious metals. So why the sudden reversal? And why, just days after his position went public, did the Trump administration quietly convene 54 countries for an emergency meeting on critical minerals? What do they know that we don't? Welcome to Financial Crisis Explained, where we decode the economic warfare happening behind closed doors. Now, I know you've been watching the markets long enough to recognize when something doesn't add up, when the official story and the real story are two different things. So do me a favor. If you value straight analysis without the noise, hit that subscribe button. Not for me, but because when the next crisis hits, and it will, you'll want to know what's coming before the crowd does. And tell me in the comments, where in the world are you watching this from right now? Let's see how global our community really is. Now, let's begin. In the first week of February 2025, a transaction occurred in Shanghai that most Western investors completely missed. Bianeing, a low-profile Chinese trader with a track record that reads like financial legend, quietly established the largest net short position on silver in the history of the Shanghai Futures Exchange, $300 million, betting against silver. To understand why this matters, one must first understand who Bianeing is. This is not some reckless speculator chasing headlines. This is a man who made nearly $3 billion from bullish gold trades when the rest of the market was still debating whether precious metals had a future. He saw what others didn't. He positioned accordingly, and he walked away with generational wealth. So when a trader of this caliber, with this track record, suddenly reverses course and bets against a precious metal, markets pay attention, or at least they should. The position itself is staggering in scale, 30,000 contracts, representing approximately 450 tons of physical silver, all structured as short positions through the Shanghai Futures Exchange. For context, 450 tons represents roughly 1% of total annual global silver production. One trader, one position, one market. And here's where the story becomes genuinely perplexing. In the weeks immediately following Bianeing's short position going public, silver prices dropped 16%. His paper gains? Substantial. His timing? Impeccable. But timing alone doesn't explain the strategy, because Bianeing isn't known for short-term trades. He's known for understanding long-term structural shifts in commodity markets before they become obvious to everyone else. So the question emerges, what does he see? What structural change in the silver market is so certain, so inevitable, that it justifies a $300 million short position? There are three possible explanations. The first is pure speculation. Perhaps Bianeing simply believes silver is overvalued, that the recent rally was unsustainable, and that prices will naturally correct downward. This is the benign interpretation. The second explanation is more troubling. Perhaps Bianeing has information about Chinese industrial demand, or global supply chains, or strategic reserve movements that suggests a near-term glut in physical silver availability, information that Western markets don't yet possess. This would be informed positioning based on asymmetric intelligence. The third explanation is the one that keeps commodity strategists awake at night. Perhaps this isn't a bet against silver prices at all. Perhaps this is coordinated price suppression, designed to allow accumulation of physical metal at artificially depressed prices while profiting from the paper market decline simultaneously. In other words, short the futures, buy the physical, and profit twice. History provides precedent for this exact strategy. In 2010, China restricted rare earth element exports, causing global prices to spike, while simultaneously Chinese entities had positioned themselves to profit from both the physical shortage and the futures market chaos. The playbook exists. The question is whether it's being deployed again, this time with silver. But here's what makes this situation fundamentally different from typical commodity speculation. Silver is not just another industrial metal. It occupies a unique position in the global economic system. It is simultaneously a monetary metal, an industrial commodity, and a strategic resource for defense and technology applications. Its supply is inelastic in the short term. 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. You cannot simply increase silver production by raising prices. The production timeline is measured in years, not months. And current demand trends, driven by solar panel manufacturing, electric vehicle components, and advanced electronics, suggest consumption will exceed production for the foreseeable future. This is what economists call a structural deficit. And structural deficits in strategic commodities don't typically resolve through price declines. They resolve through price spikes, supply disruptions, or geopolitical intervention. Which brings us back to Bianeing's position. Why would an experienced commodity trader, who made billions betting correctly on gold, suddenly bet against silver in an environment of structural deficit? Unless he knows something about the geopolitical landscape that changes the equation entirely, unless he understands that markets, even commodity markets, can be manipulated when nation-states decide strategic resources are too important to be left to free market dynamics, unless he's not betting against silver fundamentals, but betting on political intervention in the silver market itself. And if that's true, then what happened next makes perfect sense.